Hey guys, hope you are all having a good morning today. One of the coolest and most warming comments I get in the morning videos is when people tell me they listen to them on their way to work. Comments like that really make my day, and for some odd reason I sometimes find myself thinking about that. The other day, while pondering how lucky I am to have such a loyal following that likes my content while driving to work, I instantly thought about gasoline. Gas prices have blown up out of proportion during the last couple of months due to inflation, and with the latest numbers not signaling any notable improvements in the short term, I found myself digging for answers, the real answers that is, as to why petrol prices are so out of control, and my deep dive into this led me down a rabbit hole that I did anticipate. The reason why petrol prices haven't gone down, and won't go down easily in the foreseeable future, has less to do with the White House politics, and more to do with a secret and nefarious business model that was implemented to satisfy the endless greed of Wall Street, and on this lovely morning, we are about to explore and expose it all in this very instance. Before we start, let me quickly state that I am not a financial advisor, and that all content discussed in this channel is simply information gathered that I deem important for people to know, so that they can make informed decisions. All efforts are aimed to better understand the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive right in. You might have heard it in the news, you might have laughed about it on social media, or you might have even seen it yourself at the gas stations. The Joe Biden stickers saying, "I did that," with his hand pointing at the price per gallon you pay when filling your tank, has become very popular as of late, and I am sure it will become something you will hear a lot in the next upcoming elections. It is easy to look at current inflation and place all the blame at the current administration, but if you look and track the real causation for the sudden hikes in gas prices, the road will not take you to Washington, D.C. Instead, you will find yourself surprised when you instead reach the famous Wall Street sign. That's right, the root of evil when it comes to gas prices is not in politics, or at least the vast majority of the blame certainly isn't going to be found there, but rather in the same place where the most evil and powerful institutions of the world rest. Let's stop beating around the bush and lay down the facts as they are. The reason why gas prices are high is because there is a lot of financial pressure currently crushing big oil companies that have made them give in and change their financial method and approach to doing business. Investment in new wells has fallen more than 60%, a figure that should worry investors and be making headlines, which coincidentally the mainstream media has ignored. As a result of new oil well development falling 60%, crude oil production plummeted by more than 3 million barrels per day. With the onset of the pandemic quickly taking place as this was taking place, it failed to recover with the economy. I will not be the only one saying this, but we were heading for a full-on market crash before the pandemic hit, and any reasonable and non-bot economist will tell you this. Oil was set to turn things over, but with the pandemic arriving just in time, Wall Street was saved by being in good grace by the Fed, in particular their relationship with Fed Chair Jerome Powell, whose policies aim to isolate Wall Street and the stock markets from the rest of the economic fallout that we have all been living in. Anyways, oil executives faced a lot of scrutiny and challenging demand for a more paced capital spending after a spree of developments took place throughout this previous decade that ended in 2020. This led to a cash drain, which led to demands that oil companies favor a business model that abstained from fast growth and instead concentrated on steadier profits and stock-boosting finance moves like offering better dividends. So, in smoother words, during the last decade, there was a lot of change in the energy sector, and this resulted in the energy sector being the worst performer in the S&P 500. To combat the poor results, 2/3 of the largest American energy companies raised their dividends to really high percentages. Equity holders are not more concerned with getting cash for holding their stocks rather than actually seeing the companies grow. You can blame Biden and Trump, or even the pandemic as being the causing factor of this, but there was a trend line that has been falling for years way before any of these two presidents held office or before the virus began to spread out in 2020. Tracing back this problem will take us back to 2014 and 2015, and we will find ourselves looking at Russia and Saudi Arabia. After oil prices tanked in 2014 and 15, gas reached prices as low as $1.72 per gallon. Some organizations linked up with Russia to contain oil production. Russia had been outstripped American demand production back then, rising to 9 million barrels per day as of 2016. Daily worldwide demand has now reached about 100 million barrels according to a report by British Petroleum last November. Even during Trump's presidency before the pandemic, the OPEC has let gas prices increase. But it wasn't until the pandemic arrived that the prices plunged. This pushed oil drillers to cut production back to 9.8 million barrels per day by February of 2021. The decisions of the OPEC have been terrible, and have been referred to as being similar as to that of a cartel, which, funny enough, I made a huge 30-minute video on how Wall Street and friends borrowed the handbook as to how to run operations using the same methods of mafias and cartels. I will link that video in this video's comment section. The OPEC's behavior in influencing current prices should be enough to get them subpoena into a congressional hearing. OPEC continues holding their own productions at levels that are in sharp contrast with what the general logic implies they should. But they are not the sole reason for the current high prices in gas. So back in 2014, we saw the last peak of investments in finding new wells. Ever since then, investments has fallen sharply, which has made it hard for drillers to react quickly to the volatile and ever-shifting economy we have. Ever since older wells were capped, newer ones haven't been made able to fill up the production gap at a pace enough to maintain things steady. As such, the new initiative has become to pressure companies into halting the cash they drain. The drop of independent oil forces a series of mergers and acquisitions of independent oil producers, which made them seem more risky to debt markets, which then caused producers to have to pay more attention into stockholders' strategy demands. As analysts at IHS Markit have said, the best way to make sense of this whole scenario is that shareholders have been subsidizing the global price of oil. And if this wasn't enough, you can also add the pressure that environmentally conscious investors are putting in these companies to lower carbon emissions. There is also a very real threat these oil companies have with the emergence of electric cars. They are at a point where their futures are uncertain, and many may need to start working hard to take measures and find another product to sell because the future of oil is looking to be extinct, relegated to the history pages. Companies simply don't know where things are going or how quick they will change. There are clear short-term solutions for these companies. There is plenty of room to boost production with many areas in the United States with oil that would cost $50 or less to produce, but because they are more worried with appeasing Wall Street shareholder and big money, they will rather let the United States sit in this gas price problem for longer than it needs to. In contrast to them, privately owned oil firms are moving faster, since they don't have to appease shareholders' greedy demands and pressures. These are the reasons you will find when you track down the real problem as to why gas prices don't come down. As you can see, the ever-reaching hand of Wall Street find itself being culpable of yet another global problem. The solutions are easy, but greed makes it impossible to solve problems, because such problems are so financially lucrative to those benefiting from selling gas at high prices. Last thing I want you guys to know has to do with Petrol pricing model itself, so pay close attention, as this is the new business model I hinted earlier in the intro of this video. For this example, I am going to use and talk about the United Kingdom petrol prices, as they have a strong relationship with the price of oil, but have always had a bit of an asymmetry in how price changes are incorporated. We know that the rise of prices is being passed down to consumers, but the thing that most don't consider is that cost reductions usually take longer to feed through to pump prices. Petrol companies are obviously taking advantage of the consumer, so let's actually look at some data sheets and hard numbers to see how it is all being done. The price we pay when filling the tank comes from a variety of factors. The largest part is from fuel duty, then the petrol itself, which comes as a mix of the crude oil and its refinement costs. Taxes are also incorporated to be passed on to consumers. These factors are all built in as the overall price we pay. There are other costs like delivery and distributions, which bring the total profit margin to about 5% on average. What is not included in the breakdown is the cost of running petrol stations. The costs for staff wages, electricity, water, and property costs continue to rise year over year, especially with inflation. Estimates show motor vehicles are traveling less than pre-pandemic levels since many are working from home and unemployed, with some numbers putting it at 16% less traveling than pre-pandemic levels. As a consequence to all of this, with less traffic to the gas stations with increasing SOTs, petrol retailers are being forced to adjust pricing to ensure their profit. As such, a big part of why those prices are growing is because gas stations have been forced to have to also increase prices if they want to be profitable within the same margins. This goes to show the effect and forced decision-making that Wall Street imposes over everyone else, all because institutional investors need to be appeased. Their appeasement isn't just profiting, as we made clear. They have clear outlines that they present to the oil companies, often forcing them to do things that the companies wouldn't have done, all because Wall Street wants to maximize returns by causing price havocs. Wall Street not only manipulates stocks, but they also manipulate gas prices indirectly. They are always in the middle of every problem in the world, and it's time to start cracking down on their power. They have become too dominant in every aspect of our lives, and because they live to satisfy their insatiable egos and pockets, we need to be well aware of how they operate so that we can beat them at their own game. I hope to have inspired some wrinkles in those smooth brains of yours this morning. Thank you for making it to the end of the video. Let me know your thoughts and comments below. I have no measure to tell if you enjoy this type of content other than your feedback, so go all out down there. I have a Patreon link in the description as well as some one-time donation links for Cash App and PayPal. Thank you again for being a part of this channel. I will continue striving for better content. Hope you keep having a great day, and I hope to see you later today on the recap video. Until then, keep on buying the dip into the moon.